There's a pressure building quietly in global markets that most mainstream coverage either glosses over or hasn't properly understood. It's not a stock market crash, it's not a banking collapse, it's liquidity tightening. In this video, I'm going to explain what a liquidity crisis actually is, why 2026 is beginning to show early signs of liquidity stress, and why gold at $5,280 and silver near $94 and platinum up almost 9% this week are signals. Because liquidity drives everything. It drives credit spreads, it drives margin calls, it drives dollar strength. And when liquidity tightens, markets don't just fall, they behave differently. If you understand liquidity early, you position yourself before the crowds react. Now stay with me and I'll show you the one relationship between credit spreads and precious metals that will tell you whether this is controlled tightening or the early stages of something more disruptive. Welcome to Money and Power. If you're new here, this channel focuses on macro liquidity cycles, gold and silver markets, dollar strength, credit conditions, margin dynamics and systemic risk all in one, without drama or hype. And before we go further, there's one important structural change to mention. Up until now, our weekly market update has appeared on Saturdays here on YouTube. From this week onward, the full weekly briefing will move to Sunday, published in depth on the 2% brief on Substack, with a shorter structured summary continuing here on YouTube. The reason's simple. The Sunday Substack edition allows us to go deeper into liquidity, credit spreads, funding markets, metals positioning, and allocation signals without the time constraints of a YouTube format. The YouTube version will continue, though, to give you the framework and the key signals. But the full breakdown, the complete liquidity map for the week ahead, will now sit on Substack. So if you rely on the weekly intelligence update, Sunday is now the anchor point. That's why subscribing to the 2% brief matters. It's free, structured, and designed for those who want the deeper layer behind what we discuss here. The link is in the description and comment section below. Now, let's deal with liquidity properly. Liquidity simply means how easily capital can move through the financial system without creating instability. It's not about markets rising or falling. It's about how smoothly markets absorb buying and selling. When liquidity is abundant, buyers and sellers transact easily. Credit is accessible. Volatility fades quickly. Corrections are shallow because capital flows back in. But when liquidity tightens, markets feel different. Prices move further on smaller volume. Funding becomes selective. Leverage becomes more expensive. And volatility persists instead of fading. A liquidity crisis is therefore not just falling prices, it's when the plumbing of the system begins to strain. And in 2026, we're not in a collapse, but we are seeing tightening. Look at the price action this week. Gold is around $5,280, up roughly $170 on the week. Silver, $93.84, up around $9, more than 10%. And platinum, at $2,385, up close to $200, around 9%. Palladium, broadly flat. Now, silver and platinum are the two metals we highlighted recently, and they are leading, and that leadership matters. In a classic liquidity crisis driven by margin calls and forced selling, precious metals often get liquidated alongside equities. Investors sell what they can to raise cash. Now, that is not what we're seeing. Instead, metals are strengthening into uncertainty. That suggests positioning, not panic. Capital is reallocating defensively, not being forced out indiscriminately. That distinction tells you we're in rotation, not cascade. Now, where does liquidity tightening show up before it becomes obvious? Well, first, credit spreads. Now, what are they? Well, credit spreads measure the extra yield investors demand to hold riskier debt over safer debt. When liquidity is strong, spreads are tight. When liquidity tightens, those spreads widen. Now, if you want to understand early liquidity stress, watch credit spreads before stock indices. I'm giving you some really good insider knowledge here. Might be a little bit technical, and I'm sorry, but it really is important and will provide a very good foundation of information before you make investment decisions. Second, funding markets. When borrowing costs rise or lenders become cautious, leverage becomes less attractive. That slows risk-taking across the system. And third, the dollar. The global system is dollar-based. When the dollar strengthens, global liquidity tightens. Countries and corporations with dollar-denominated debt feel that pressure. Servicing debt becomes more expensive, and that ripple effect builds quietly. Fourth, this is technical, cross-asset divergence. When defensive assets rise, while growth-sensitive assets hesitate, that divergence signals repositioning, which brings us to copper. Copper reflects industrial demand and economic activity. If copper begins to soften, while gold and silver strengthen, that combination suggests growth expectations are cooling, while monetary hedging increases. Do you see? Silver and gold, monetary. In that case, that is classic late cycle liquidity behavior. Now layer in geopolitics. We've seen heightened tensions involving Iran this week. Geopolitical shocks can amplify safe haven flows, but they do not create liquidity cycles, but they do expose them. If liquidity is abundant, shocks are absorbed. But if liquidity is tightening, shocks produce repricing. Now, the fact that precious metals are strengthening into geopolitical tension suggests capital was already cautious. Now let's look at margin calls in more detail. Margin calls occur when leverage investors must post additional collateral due to volatility or price movement. In true liquidity crisis, margin calls trigger cascading selling. Participants liquidate assets broadly. That accelerates declines, but we're not seeing cascading liquidation right now. We're seeing rotation. Because rotation is strategic, cascade is forced. Markets move from rotation to cascade only when liquidity tightens further and confidence weakens sharply. Now, before we go further, a reminder, at the end of this video, our latest 3 briefings will appear on screen, including deeper analysis on metals positioning and dollar liquidity. If you want to connect the dots properly, watch those next. So why does all this matter? That's what I'd be asking at this moment. Well, liquidity tightening does not just affect traders or hedge funds. It filters directly into sectors people invest in and companies people recognize. Take commercial real estate. Over the last decade, many property developers and office landlords refinanced repeatedly at very low interest rates. When liquidity was abundant, refinancing was straightforward and cheap. But as funding conditions tighten and yields remain elevated, rolling over that debt becomes more expensive. Cash flow is squeezed. Asset valuations come under pressure. And suddenly what looked stable begins to look stretched. The same applies to highly leveraged growth companies, particularly in parts of the technology sector that expanded aggressively during periods of cheap capital. When money was easy, growth was funded through debt or equity issuance without much resistance. But when liquidity tightens, investors demand profitability and balance sheet strength. Access to capital narrows, valuations compress. Now, nothing breaks overnight, but conditions do become harder. It also affects the national debt. Governments refinance constantly. When liquidity tightens and bond yields rise, the cost of servicing national debt increases. That reduces fiscal flexibility. It makes stimulus more difficult, and when debt to GDP levels are already elevated, markets become more sensitive to confidence. So for ordinary investors, especially those holding precious metals, this matters. If refinancing across property, technology, and sovereign debt becomes more expensive, capital begins to value resilience over growth. That's one of the reasons gold, silver, and platinum are strengthening now. Not because of panic, but because liquidity is no longer effortless. This is where the key relationship comes in. Watch the interaction between credit spreads and precious metals. If credit spreads widen while gold and silver remain firm, that signals controlled liquidity tightening with defensive positioning. If spreads widen sharply and metals begin selling aggressively alongside equities, that signals forced liquidation, a more acute liquidity crisis. And that relationship is your early warning signal. Liquidity cycles tighten gradually until they don't. Right now, we're in the gradual phase. Markets are sensitive. Gold's up $170. Silver up over 10%. Platinum up sharply. These are not random moves. They are signals of capital positioning under tighter liquidity conditions. Watch credit spreads. Watch copper. Watch dollar strength cycles. Watch whether precious metals maintain leadership. Those indicators together will tell you whether 2026 remains control tightening or moves towards a sharper liquidity crisis. If you want the deeper weekly breakdown, where we analyse spreads, funding markets and asset allocation in full, the 2% brief on Substack goes further than we can here. And this was long enough, let's be honest. The link is below. Thank you for watching. If you value calm, independent macro analysis on liquidity, gold, silver, the dollar and systemic risk, subscribe to the channel and enable notifications. I'll see you in the next briefing.